Today we're going to talk about how Redfin and Keller Williams CEOs believe the market has bottomed. The Fed meeting minutes and how it relates to real estate. We're going to talk about a Richcession, whatever that means. And lastly, we are going to finish up with Grant Cardone coming after Dave Ramsey on our podcast today.
And there's crazy things going on right now in the economy today. The stock market is dropping. I have a theory and kind of I want to make a guess of what's going to happen, but then all kinds of news coming out, headlines galore. So let's just start. But what's kind of like the first things on your mind before we get into the topics of where real estate is?
Real estate, it's on fire. I mean, real estate's busy right now. Yes, transactions are down, but there is a lot happening and there's a lot of opportunity, especially on the investor side and on the new construction side. The first-time home buyer, hard. Luxury, some deals, but surprisingly resilient because, rates are over 7% right now. Surprisingly resilient.
Yeah, and the reason I asked that is because this first headline is housing market has hit rock bottom, says Redfin CEO Glenn Kelman, and Gary Keller says the market has hit bottom. Only way is up, which is funny because it's contradictory to what you just said. Market's hot, hot, hot. Prices are all-time highs, but this is saying rock bottom. So let's dive into this and maybe bring people up to speed with what that actually means when they say that.
So you've got these two CEOs of these big companies, Gary Keller, Glenn Kelman. They're both saying the same thing, but attacking it from different aspects. What they're saying is on a national level, and I was referring to the Seattle market when we were talking right before this, but on a national level, it shows that basically prices have bottomed and that it's going to continue up from here. Prices for us here in the Seattle Metro, of course, bottomed in February of 2023, and we've been continuing up from there. The West Coast quite often will lead most of the country in a recovery or something of that nature. What's really interesting, though, even though these CEOs are making different points, is they are basically saying, hey, that price correction, that was it. Enjoy it. There's nothing more that's happening. Expect it to go up from here. Both of them also say in different ways, expect the market to be tougher for real estate agents. Expect transactions to be down because rates are high. This is not, we're not going to go back to the 6 million transactions that we had before. Expect transactions nationally to hover around 4 million transactions a year, which is still a decent market. And so these fears of the crash, the tsunami of foreclosures, the Airbnb myth that we had to debunk the other day, all the builders having to lower their prices and give up their inventory, it's just not happening. So there's clear data now that the market has started bottoming and that it's going to continue to move up from here. Now, does that mean it's like permanent and like it couldn't go down again? No, because if major economic change or war or massive inflation kicks in, then that could definitely change everything. But there's a lot of signs that are pointing towards, hey, we just passed the bottom. Have fun going up the other side.
What does that mean for buyers, sellers, investors?
I think when you're thinking about it as a buyer, now once again, it's going to depend on where you're at locally because every real estate market's made up of a local market.
Let's talk about Seattle then.
Perfect. Here in the Seattle Metro, we've already been seeing the price appreciation. It's get in now. Because if you don't get in now, what's going to happen is in 2024, it's just going to cost more. It's going to be more expensive. You're going to see above average appreciation, even at 7% because supply is so low. If you're a seller, we don't have a lot of your traditional move-up sellers coming into the market right now because of the lock-in effect like we spoke about before. If you have to sell, get it done and make sure you're going to get a good deal on the other side. If you don't have to sell, for a lot of sellers, it may not make sense to sell and trade in that 3% mortgage for a 7%. For an investor, mark my words, Q4 of 2023 is going to be your best buying time of the next 3 years. Here's why. All the inflation won't be done. There's still going to be some fears about the economy. But we know inflation is trending down. We know the Fed is going to have to lower interest rates. But there's that last bit of fear that's going to be left in the market, which is going to be one of your big opportunities to capitalize. Because we do believe we're going to have a slightly slower winter than normal. As things get slow, some people may panic, or they may need cash, or they may need a deal. I got called yesterday and they said, my house goes to foreclosure on Friday. Can you stop the foreclosure? And I go, oh my goodness, why didn't you call us a couple weeks ago? It's not impossible, but it's very hard to get a foreclosure stopped 2 days before the auction date. So I said, yes, if you want to take a cash offer from us, we'll go stop it. Well, what's your cash offer? I was like, $350. And they go, we owe $300. I said, cool, that's my offer. And they go, can you stop it? I said, probably, and you'll net a little bit. It's worth probably $500, but the odds of us stopping it are still really low, but that's what's happening. So you're getting some of these buildups. And this was a rare circumstance. Realize the foreclosure rate is so low. And they just happen to know someone who knows someone, and they were like, oh, call Anton, he'll give you a cash offer. I said, ask your significant other, they're getting a divorce, if they'll go for it. And in the reality is I could also increase my offer, but I just wanted to see, what they were willing to take on that. They never called back. Unfortunately, that one's probably going to go, and I don't think we could have maybe even saved it anyway. But that's what you're seeing, is you're seeing this as summer cools down and we head into the fall. You're going to see a little bit more fear, which is good for investors. Just great.
And all that's going to hinge on what the rates are. So the second topic being Fed minutes. The FOMC meeting minutes were released. So explain what FOMC means and the significance of that to rates.
Yeah, the Federal Reserve is not just Jerome Powell. There's like a board. They all meet. They talk about what's happening.
Different branches around the country.
Different Fed presidents, different branches, and they get to give their input. The FOMC is the Fed Open Market Committee. So you get to see their notes. They actually publish their notes, and they tell you how they're voting, what they're thinking, and they kind of give you a little forward-looking indicator. And as super nerds, we open them and we grab our highlighters and we read through them.
Or me, I just watch every single video that covers them.
Well, and I mean, I do some of that too, because what I'm trying to do is I'm trying to get multiple perspectives. So I read them, and then, I'll watch something from multiple other YouTubers to get their opinion on it too. That way I'm filtering it through multiple biases. But here's what was very interesting. The last Fed meeting, you had a couple committee members saying, let's keep rates steady. So that means the camp is starting to divide, versus before we had a unanimous raise, or whatever they were doing. They also, though, in this one we don't like, they said there is a continued risk of significant inflation. And they actually use the word significant risk in there. The Fed is going to overdo this a little bit because that's what they've always done. So they're going to sit here, and even though the fire feels like it's out, they're going to pour water on it. They're going to throw dirt on top of it. They're going to drive an excavator over the top of it and just flatten it dead. Because what they are genuinely afraid of was in 1974, the Fed eased off and inflation roared back. Then it looked like it cooled off again and it roared back up into the 80s. So they want to make sure that they stomp it all the way out and that it's complete. You're also seeing employment, and of course they measure unemployment, but the unemployment rate is not moving up. So employment is being very, very strong relative to these rate hikes. They do believe supply and demand is getting into balance, which is nice. And the Fed expects inflation to start easing into 2024 and for them to hit their number by 2025. Magically, it starts easing in 2024, heading into an election year. I just want to throw that one out there. They did also talk about the soft landing. Now, let's ignore the Fed for a second. I went in, I started Googling right before this. There is more sentiment, and you can see it on Twitter and X, whatever you call it now, and in Google, of this idea of this narrative of the soft. And so the Fed is talking about it, and the general public is talking about it more too. And so the Fed may be able to do this. See, inflation is based a lot upon expectations. If we expect inflation to go down, it goes down. If we expect it to go down, we spend less. If we expect the soft landing, we start to get it. If we expect it to run out of control, it runs out of control. So they're doing a very good job of keeping consumer expectations in line with what they want. It'll be interesting to see in the next conference when Jerome Powell comes out and speaks, I think we'll get a slightly softer Jerome Powell on the next one, and we may get a pause or we may get a hike. At this point, it doesn't really matter. I'm still emotionally invested in my call of no more hikes.
Yeah, $100 is on the line.
I'm probably going to lose the $100.
By the way, we never clarified. Is that on the next one or just this year?
Oh, that's on the next one.
Okay. So it's 50-50.
But the other thing that they did mention in their notes that we need to keep into our minds, higher for longer. They mentioned it again. Okay, buyers, this is what it means for you. Please, the rate is going to be temporary, but it's going to be there for at least 1 to 3 years. Investors, same thing. We had an investor looking at sixplex, beautiful townhomes yesterday, and we asked him what he was going to do. And the gentleman said, I think I might put 50% down on this project. I'm going to have the high rate for now. And then 2 to 3 years from now, when rates drop, he's like, I think I'll probably do a cash out refi, keep this, go redeploy my capital into something else. But I'd feel very safe doing that today, even with rates being over 7. And then lastly, as a home seller, if you don't have to, it may not be the right time. But if you got a good plan, okay, so let me explain. If you're downsizing, we're going to sell that big home and we're going to move down the property ladder, that may make phenomenal sense today. We need to run the numbers. If you're going to just sell a second home, pocket the cash just to feel safe or buy an investment property, that may work. But the person selling their home and just moving up the property ladder, it's very unique. It's more have to than want to today.
And that's what's not only causing the situation, but it's going to prolong it, meaning they want to keep that low rate.
Yes. Right?
Some people high 2s, mostly 3 and 4s, and not get into a higher rate, being the right now 7s. And I've heard things that maybe it could get up to 9, right? Or 8 or 9, which is crazy. So then you're really babying and keeping that low rate. But can you summarize generally what did the Fed say in those minutes? What's going to be their action? And then what is going to happen to mortgage rates?
The Fed was higher for longer. We still may raise. We have not stomped out inflation completely. And there was a divergence of the meeting where a couple members said, hey, we're starting to feel good. Maybe we should start pausing. What that means is it's taking down the probability for the next rate hike. I still think we might get it, though. We're going to get another 25 basis points at some point, but then I feel like we're going to be done after that. What we have to do is we have to just simply watch inflation, watch the economy, and look for cracks. Because if you start to see cracks in banking and the commercial real estate sector, and those start to get really big, or unemployment starts to jump up, the Fed will respond quickly. So they can respond very quickly to stimulate the economy. Their tightening cycle takes a lot longer to go into effect. So they're going to pinch it down. It's like you're sitting there watering your plants and you grab the hose and you bend the hose in half and it kind of pinches the stream down. That's what these high rates are doing, is they're pinching the money flow down. They're pinching down the velocity of the market by simply bending the hose. Well, the Fed can just do the same thing and just pop it right back open and turn it right back on. And money printer go. They're just going to wait until they feel more comfortable. But because not all members said we have to keep doing it, we're nearing the finish line.
All right, so this next headline is, as recession fears fade, we may be experiencing a Richcession instead. Here's what that means for you. I've never heard that term, Richcession.
I'm not sure exactly who coined the term. This is a great article in CNBC. So we have there's a lot of speculation, like, is the recession still on the horizon? What's happening right now? Did we actually already go through it and we just missed it? And some economists are saying we're having this Richcession. In other words, the white collar worker is being hit disproportionately more than the blue collar worker or the lower end of the wage scale. Because when you look at the unemployment numbers, and the unemployment data, and then the JOLTS report, which is people getting out of one job and moving into another, the layoffs have been disproportionately higher in white collar jobs while the unemployment rate still remains at a 50-year low. So, example, you see Facebook and Google lay off tens of thousands of people. Those are all white collar jobs. You're not hearing about a factory laying off 10,000 people, or construction, or any, and construction is going like gangbusters. And especially, I mean, here in the Seattle Metro, construction's busy. And throughout most of the U.S., construction's busy. I mean, previously we've talked about this. Builders are killing it right now. That's an opportunity. But what's interesting is that's not the normal narrative. In a recession, what usually happens is the lower income bracket gets hit the worst and the most.
That's why, hence, Richcession.
Richcession. It's hurting the rich people. And it attacked their stock portfolios, it attacked their ability to lend, it attacked small businesses' credit and, the home equity lines of credit. And for the first time, we're seeing real wage growth happening at the bottom end of that spectrum. You haven't seen wage growth really happen like this since the 70s at the bottom end, which is phenomenal. That's good for the middle class. That's good for the economy. That's good for housing. It is inflationary, though. So one of the things that the Fed is watching and that they're looking at is wage growth is a little too hot overall. That's inflationary. Because if someone works at McDonald's and you have to start paying them more to work at McDonald's, the price of the cheeseburger goes up. Plain and simple. So that is an indicator that they're definitely watching, and they're seeing a lot of upward pressure on that. Part of that also too is because our immigration funnel of recruiting everyone from the nuclear rocket scientist all the way to the construction worker has been cut down. So we haven't been bringing in as much labor as we normally would. Plus, with COVID, we saw a lot of people just abandon the labor force, and some have come back, but our labor force participation rate is still much lower than it was pre-COVID. They're just opting out and saying, I'm done. So in order to get this wage growth under control, and I want to make something very clear, I want people to make more money, okay? However, I want inflation stomped out more, because if inflation is not put under control, the economy has to suffer, and that makes everyone suffer. We need good, sustainable, consistent wage growth and not 5-10% wage growth, because that's just too high. P.S. Everyone, go get a raise right now, because you probably can. Okay. Now, if you're a white collar person, here's the other part that's interesting, that the headline, it's clickbaity, it's catchy. Most of the white collar workers who lost their job were immediately able to get another job in another place. Some had to take minor pay cuts. Oh well, that's not really hurting the economy. The last thing too that's very interesting that the Fed is watching here is that the GDP numbers are coming in higher and hotter than they expected, which is very interesting too. So you've got this white collar layoff happening, you've got the lower end blue collar really rising, and GDP outperforming expectations. GDP would be the measure of our gross domestic product, aka how you measure the US economy. Thoughts? Questions?
Well, I mean, on the GDP part, I'm not an economist, but GDP being gross domestic product, right? Yep. The health of the economy. It's interesting because there are stories about China's really slowing down. The rest of the world too, you have to put it into context, because we always talk about our market, Seattle. Yep. We talk about our country, the United States. But if you, in the context of the world, well, there is a war going on in Europe and they're dealing with their own things. Yep. Asia might not be coming back as fast. I mean, when it comes to central banks. So one of the reasons why we're doing so well, potentially, is just because we're the healthiest of all the sick people. Yeah. And we are the money printer. I talk about this a lot, how the closer you are to the most powerful central bank, the more opportunities you're going to have first. And I don't know if this is going to last forever. So my kind of thoughts when you say everything, one of the things I ask people every single day, whether it's a friend or family or just somebody I meet, is, how's your grocery bills?
Oh, yeah.
Right? I just ask that because everybody can relate. Nobody has said, oh, what are you talking about? They all react like, that's crazy.
Yeah.
It's so expensive. And it's not just like people living paycheck to paycheck, even rich people, right? So, and then it's just a conversation starter. Everybody is seeing all their expenses going up. So naturally, what happens when you're spending more, not just on food, but everything else, you're spending less in other places.
Yep.
Very simple, supply and demand. And the fact that people just don't have as much to spend on things, well, that's going to start creating more cracks. So when you say all this stuff, I think that if you put it into perspective and has some context, I believe you already said this going into winter, and we are kind of seeing signs of it right now in the stock market and some of these headlines coming out. We're going to start feeling the pain coming up. These high interest rates, interesting enough, there's a lag effect there as well in terms of how it affects not just the economy, but business and real estate. So I guess my question for you is, am I on the right track here? Because you should never time the market as a real estate investor, buyer, because it's almost impossible. Nobody can really do it. You can have a general idea of what direction it's going to know, like, should I wait another 6 months, right? Should I pull the trigger right now? But I believe that what we were going to see that we haven't seen, maybe we're going to see just play out a little bit later. And then that's my last thought too, in terms of the Fed. I feel that they are just doing all this, keeping rates higher for longer and potentially raise one more time to give themselves a little cushion for when things get bad.
They give themselves ammo. So they can come in and be the firefighter all over again.
It's bad guy right now, good guy when the time is right.
Yeah. You can be the hero and put out the fire you started. So to kind of just reiterate what you were just saying, you see cracks in the economy, and you can see that consumer spending going down because their bills are more expensive. I think what the average person needs to understand is when the government is talking about inflation going down, it doesn't mean prices went down. It means the rate of price increases slowed down. That's not a price decrease. So mentally, we need to kind of get it out of our head. Prices will not return to where they were. They might come down a little bit, but they're not going to go back to pre-pandemic levels. You can't print $6 trillion and not expect all prices to rise. So unfortunately, our grocery bills are going to be more. Lumber is going to be more. Labor is going to be more. What does that mean for our audience? It means you got to figure out how to make a little more money. You got to figure out how to be a little more conservative and frugal. You've got to figure out how to make some good investment decisions, both in real estate and outside of real estate, so that you can increase your cash flow, which increases your safety net. And you got to get rid of high debt. If you have high debt, because as the Fed continues to raise, credit card debt becomes more expensive, HELOC debt becomes more expensive. If you're trying to buy a new automobile, it becomes more expensive. In the last CPI report, auto insurance has shot up like almost 18%.
Don't get me started about insurance.
It's so expensive. And another thing that happened, and this really hammered us here in Washington State, is Washington State passed a bunch of additional regulations. So all the insurance providers in Washington just bumped everyone's insurance. But it didn't happen like, oh, it's a slow trickle. It was a stair step. It was run into the wall and prices shot up all at once. We own an insurance brokerage. So we're getting these people who are calling right now and say, my bill just jumped, $200. One person's bill jumped $2,400. And they say, we need a new quote. So our business partner there is happy to get them a quote. And yet at the same time, you have to realize, one, that's happening nationally. And two, there are some specific states that have above average increases due to regulation, like Texas also has the same thing, California, Washington. So unfortunately, there's still things that are frothy, that are boiling over in the economy. They're still popping up, and you're like, I thought we were through this. But that's what the Fed is watching. They're watching, trying to make sure everything cools off. And in the last read, shelter made up like 90%. Now, there's some of the shelter, because it's a 12-month thing, is going to roll off, and we're going to get some better numbers here moving forward. But if houses start appreciating rapidly and rents start going up rapidly, well, that's just going to recontribute to inflation. This is why it's higher for longer, but we're still almost there. And there's some fear. And that almost there and the fear is what creates that opportunity that you were talking about.
Wow, it's a lot to chew on. Do you want to move on to the next point?
Yep.
Okay, cool. The last one is about Grant Cardone. You don't need savings. Grant Cardone blasts Dave Ramsey. If you don't know, Dave Ramsey is a popular finance channel on YouTube, just generally on podcasts. And he says, save your money tips. Grant says, real estate is much safer investment. So explain.
So Grant Cardone goes on MoneyWise. P.S. Like both of these guys, Dave Ramsey's philosophy is a little too austerity. You got to hold off, and a little too slow for me. And Grant Cardone is also a little too chest pounding for me. So I'm kind of more towards Cardone, not all the way to Ramsey. But he goes on MoneyWise and, essentially bass Ramsey. He said, and this, I loved this quote, so I want to actually read it. Cardone said, real estate is the least risky thing to me as long as I have time and I'm not over leveraged. That is so spot on and true. I mean, what a great quote. And he said, what happens is you'll get a partner or equity and they'll put a gun to your head and they'll say, you have to sell right now. So true. So I want to unpack this for a second, then we'll go into their dialogue. When you're doing investment deals and you have partners involved with you or equity involved with you, you have to make sure that everyone is on the same page and you have the same time horizons. Because even in the Great Recession, when the market dropped here in the Seattle Metro, 40% in some areas, if you didn't sell and you just waited, it was worth money and good money, again, just right on the other side. But if all of a sudden you've got partners and they stick the gun to your head and they said, no, you said we were selling in 2 years, that means everyone's got to take a loss. That's the problem. So when you're setting up your investments right now and your partnerships right now, be conservative. Run the most conservative numbers. Have extra cash and have realistic dialogues. I was having a partnership dialogue earlier today and he goes, how long are we going to hold this? 24 months? I said, I need you to think of this as a 7 to 10 year hold if you want to be involved. And he goes, 7 to 10 years? Come on. He's like, that's forever. I said, well, let's work through this. Do you think the economy is going to be all the way back in the next 24 months? He goes, no, probably not. I said, well, would that be the best time to sell? Well, I guess when you say it that way. I said, do you think it's going to be all the way back in 36 months? Maybe. I said, cool, I'll give you a maybe. I said, but if it was 5 years, 7 years, or 10 years from now, do you think the economy could be roaring again and we could be great? He goes, yeah. I said, cool. Let's plan for that. And then we'll put some metrics in here when we hit a certain cap rate or we've appreciated this much and we can provide everyone their high return they're looking for, then we'll exit. So part of it was also just a little bit of education and having a good dialogue with potential partners. But Grant just nails this. Who you get into a business partnership with, whether in real estate or just traditional business, it's like a marriage and they've got to be committed and have the same goals. We got to get into the psychology of Dave Ramsey a little bit here though. So why is Dave so conservative?
Because he went through some horrific life experiences financially. And did he have to declare bankruptcy?
100%.
Oh, okay.
So Dave was a house flipper. It was in the late 80s. I think it was like 1988. He was over leveraged, flipping a bunch of houses. All the debt got called, had to file BK. You know what? Sad story. What that did to him was that shaped a part of his life where he became the uber conservative guy. Name every dollar. Pay off all your debt. All debt is bad. Put money into your 401k. Put money into your IRA. And he calls it like the baby steps plans to wealth, the simple plan to wealth. For the majority of people, that's a great plan because consumers here in the United States, they overspend, they blow all their money, and they don't have a plan. For our listeners, for the people who hang out with us, let's make more money. Okay, let's go make things happen. Let me explain. So this is where I subscribe to what Cardone is saying. You're never going to get free and rich by simply putting in $1 here into the stock market and having no debt. Debt is just like a hammer. It's an awesome tool that can build houses and skyscrapers. When used incorrectly, you'll smash your thumb and your thumbnail turns all purple because you did it wrong. But debt is good because debt can get you your goals. As long as I'm not over leveraged and I've got the right time horizons and I'm in business with the right people.
And you have the right assets.
And you have the right assets. So I do not want to go buy an office building today. That's the wrong asset to me. Would I buy a multifamily? Absolutely. Are there some multifamily people who are probably going to need to get bailed out because they did their performer at a three cap and the market's now asking for a 4.5 or a 5? Yep. Well, it might be a good buy. What's happening is these deals are starting to pop up, and this is what Grant was, chest pounding about, is there's going to be deals and there's going to be opportunities, and you should put your money into those deals and create cash flow. A little easier said than done, Grant. And so let's take a little Ramsey and let's take a little Grant and blend it together. I do believe you should have 6 months worth of reserves in the bank, in cash, at all times, and for every property, because that creates safety and also personally lowers my stress. 2, now that I've got that, I need to go purchase cash flowing assets. And yes, that could be some stocks that give me dividends. I'd prefer real estate, it pays us better. But I need to purchase cash flowing assets. I need to get to a point where my cash coming in exceeds my monthly burn or my expenses. Then I'm protected from anything. And that's kind of what Grant was trying to say here. Then the last thing he said was he's kind of back to this idea of cash is trash because he believes the whole banking system is kind of unstable. I kind of agree with him, and that the regional banks and even the big boys are in potential trouble. And just let's play out the trouble they're in. They have to pay higher rates on their savings accounts and money markets, so they have less money to loan out. They have to bring in additional reserves right now to protect themselves because the Federal Reserve is paying more attention. And so you saw all of the banks increase their reserve amount. So they have to pay higher rates, they've got less money to lend, and they're increasing their reserves. What's that doing to a bank? It's pinching it. Now, also, a lot of them may have bonds on their books, and they were bought at the wrong maturities. That's what took down Silicon Valley Bank, was just that maturity duration error. Here's what that means in English. They went and bought assets that were performing at 2 or 3%, and now they need bonds that perform at 5 or 4.5. So to do that, you have to discount the bond in order to sell it. So these banks are getting hugely pinched. So what Grant's saying is, hey, take it out of the bank and go put it in cash flowing real estate. And I agree with him as long as we also have the reserves. And I agree with Mr. Ramsey, get out of the debt. Get out of the bad debt. So he's too much to get out of all debt. Get out of the credit card debt. Get out of the auto debt. If your HELOC's too high, we might need to get that paid off. We made that other video about how to analyze paying the HELOC off or not paying the HELOC off. But the reality is you're going to see opportunity over the next 6 to 12 months as the economy is broken and you have, breaking, and you have higher inflation. That's going to create opportunity. So if you're not ready today, start getting ready now. Start getting prepared or find other people to partner with because there are deals coming.
One question, because this is one of the reasons why Grant Cardone made this statement about real estate is a safer investment. Why is real estate a safer investment than most all other investments?
In his belief of why real estate's a safer investment is that if you have the right time horizon and you have cash flow, it doesn't matter. So during the Great Recession, some of our assets were worth 50% of what we paid for them. All we had to do was just hold on to them and sell them at a later date, and we never took a loss. And they cash flowed during the process, so we could sit there and just float on by through the recession. What he's talking about is how that creates such a margin of safety for that. Now, real estate is also one of God's assets. And there's only one earth, and there's only so much land on it. So by owning a physical, tangible asset, one of God's assets, I'm now controlling this little space. And because there's becoming more and more people, that's natural inflation is going to continue to happen over time. There is no guarantee that a stock will always go up in value. There's no guarantee a bond will always go up in value. There is a guarantee that real estate will always go up over the long run in value because it is one of God's assets and there's only a finite amount of it.
Yeah, I think that taking the route of being conservative when you're looking at deals and you're making the plan, but also understanding the reason you would have debt is because the risk is worth it long term. It's a little bit of both, not all Gordon Ramsay, Dave Ramsey, or all Grant Cardone. For the person that's maybe not a full investor 24/7, because this is one of the problems I see. People get FOMO. They see, oh my gosh, everybody's got an Airbnb. I'm going to jump into an Airbnb. Flipping. Can make $100,000 in 6 months, right? Just like hiring other people to do this, and I just sign right here. So avoiding the FOMO, but realizing long term, you can actually become a great investor. And I think that this statement is very significant on this point. People underestimate what they can make in the next 10, 20, and 30 years, and they overestimate what is safe in the next 12 months, meaning there's right now, especially with so many things going on, up and down, but real estate, you can almost for sure show historical data that one plot of land, one house, one real estate investment in general has gone up, and up, and that's partly responsible partially because of the money printing that we're doing. Inflation is just going up. Everything. There's almost nothing in this world other than TVs and some electronics that have gone down in value. But what's funny is they actually don't go down in value. They just get better, right? Yeah. And so real estate just gets more in demand because we can't build more land, but we can build more houses. But even then, the population's growing.
Exactly. So if you're in a growing population area in a metro that's got good jobs, good employment, and you've got stable income, one of the things you have to do is assume your job is never going to protect you. And then look at real estate as a protection mechanism. So you're going to buy enough real estate over that 5, 10, 15, 20, 30, 50-year run like you were just talking about in order to protect you, your family, your loved ones, and replace that income. Because gone are the days when I think you could go work for General Motors your whole life, know you're going to have a good job, great benefits, and you're protected. That's not our new economy. And I think things like AI are going to disrupt that even more. So it's paramount. It's your civic duty. It's your family duty. You need to go replace your income with real estate because your regular job is not going to be guaranteed here in the future.